Hi, it's Lee, and welcome to the Tesla Economist. Tesla has started a potential price war by dropping the prices of their vehicles to ridiculously low levels. In fact, the main vehicle we're referring to here is the Model Y in the US. After a few price adjustments already, it's now currently $11,000 less than it was before. It also gets a further $7,500 with the tax credits, and as a result, we're being told that demand has gone crazy for that car. In addition to that, Tesla is still likely hitting around 25% margin, and also receiving nearly another $2,000 per Model Y from the subsidy that they're sharing with Panasonic. Sure, they were getting over 40% margin on the Model Y before, and that is quite a big reduction. On the other hand, 25% is still a very good margin in the auto industry. This would be from the Fremont factory though. I think the Texas factory margins will be significantly lower, possibly even closer to break even, due to all the additional overheads of the former cash furnace, and now with the lowered prices. But Tesla is a long-term play, and eventually this factory will be making the lowest cost Model Ys potentially in the world, as soon as it ramps up enough to hit the economies of scale. Anyway, no matter what state of the economy, we will likely have high rates for some time, which means consumers have less discretionary income and avoid making debt purchases on items like cars or houses. If interest rates drop, then this would be due to probably hitting a recession, and in those circumstances too, there'll be fewer people buying cars. In any of these two events, the outlook for the next year or so for the auto industry is not going to be great. Sales will be down one way or another, but that would be the aggregate demand for autos, not necessarily the demand for Teslas. Tesla can keep reducing their prices as necessary so they can still sell every car they make. In short, if aggregate demand is down and Tesla are still selling every car they make, then Tesla's market share will increase without having to even build any additional vehicles. For example, if the aggregate demand in the US for autos was 20 million a year and Tesla made 2 million a year, their market share would be 10%. If the demand dropped to 10 million a year and Tesla still sold 2 million a year, then Tesla's market share would increase to 20%. From there, when the market and demand returns, Tesla can maintain market share if they're able to increase supply. In addition to that, due to electric vehicles becoming ever more popular, the relative aggregate demand will be higher for those than ICE cars. Okay, in these circumstances, it's going to be tough for Tesla to increase their supply, as every time they ramp up, they need to find additional buyers, which results in reducing the price of their vehicles. However, a 10% price drop at this stage enters into a much larger pocket of demand than a 10% price drop when we saw the Model Y was selling for closer to $70,000. In other words, Tesla are no longer high-end, luxury-priced vehicles. They're now mainstream-priced vehicles, even relative to the ICE competition, particularly when you factor in the cost savings of gas. So if Tesla did reduce their prices any further, it's going to start getting ridiculous at this stage as to what the competition are offering at the same price points. Which means the competition have two options here. One, they can retaliate by dropping their prices, which Ford have already done with the Mach-E, although the price drops were minimal really. However, they do offer a lower cost version of the Mach-E compared to Tesla, as it has less range and rear-wheel drive, whereas Tesla only sells the all-wheel drive long-range versions in the US. Also, it was likely that Ford were losing money on the Mach-E already, or at least were previously carrying a low gross margin. Then on top of that, the costs of unions and car dealerships, it makes it tough for Ford. Legacy can also cut the costs of their ICE cars too, in order to try and compete with Tesla and make them look more enticing to the consumer. However, that would really hurt Legacy profits, as these cars barely make any profit for the company on the initial sale. Most of the profit comes from after, with all the servicing and parts, along with financing. Hence why the auto industry has such a huge moat, as you'd have to survive for something like 10 years before you have a chance to make a profit. This is why EVs are able to disrupt the ICE industry, because they can offer so much more value. Consumers are willing to pay more, which in turn means they have a higher gross margin, so much so that they're actually able to make a net profit just from sales alone. Well, when I say they, it's really only Tesla. Possibly BYD are now making a net profit from their EVs, but remember, half of them are still hybrids. Of course, Tesla's price war is not just in the US against legacy autos, but also in China, the nation that purchases the most EVs in the world, with the largest domestic presence. Tesla are now competitively priced against the domestic Chinese EVs, except Tesla offer a lot more value in their vehicles. Tesla are also able to compete at these low prices and still be profitable. The majority of the other BEV makers were not profitable when the auto industry was booming, let alone now if they have to compete with Tesla at much lower prices in a down economy with higher interest rates. This will be tough for them. Most Chinese EV companies had enough cash to last them perhaps 2 more years at their existing burn rate, with the exception of BYD, who can fund its EV business with the other parts of its business, like the cell phone handsets, if necessary. Anyway, back to the US market. Tesla are very fortunate to be receiving this $7,500 tax credit. It gives them such leverage in pricing and helps demand relentlessly whilst they are working on production and able to reduce costs enough to maintain competitive even after the tax credit has gone. Tesla need to increase their supply enough to reduce the OPEX per vehicle as well. Tesla's operating leverage is a major advantage for the company, but at even 2 million vehicles a year, there's a lot more potential, especially once they hit around 5 million vehicles a year. Although that number may seem high, their current factories have a capacity of likely around 3 to 4 million once ramped. It's highly possible the next factory may be for a lower cost Tesla, although this is all going to take time. I know things that Tesla say sound so exciting, but this is a company that manufactures the largest mainstream consumer item there is, autos. It takes time to set up and get going. It will happen slowly, which is why many investors say things like, Tesla is an investment you just want to put away in a box and not open it until it's 2030. But in this price war, Tesla will not have the advantage of a lower cost model, as it probably won't be in high volume production until 2025, probably at the earliest, unless it's made in China perhaps, which I think unlikely. I think Tesla's main focus will be in the US. It's Tesla's home turf, but also those tax credits and subsidies are so tempting for Tesla. I mean, about $100 off per kilowatt hour for the tax credit and a further $45 per kilowatt hour in subsidies. Almost $150 per kilowatt hour Tesla produce the taxpayers cover. Tesla just need to make products that people want to buy using these cells, and they need to be able to ramp up the cells too. So yes, legacy autos can compete by reducing the cost of their ICE vehicles and seeing some serious losses due to such lower priced vehicles all around, or essentially massive auto deflation. Then aggregate demand would increase somewhat, depending on the economic environment. But it sounds more like a game of musical chairs, only there are too many chairs, and Tesla's chairs look much more comfortable than the competition's. Which means I think it more likely that legacy autos need to actually cut back on their production instead and start offering fewer cars. Likely stick to the markets that Tesla is not competing with that are still profitable for them. The real concern for the likes of Ford and GM will be when Tesla launches their Cybertruck. This will potentially annihilate the ICE pickup segment, which happens to be a very profitable segment for legacy. But how can they compete with the Cybertruck? This must be the coolest product that anyone has ever invented, let alone at a price point that is potentially affordable for many. What will be the result of all of this? Well, it's going to be tough for legacy to remain solvent. I think the biggest hope US legacy has is to use all those batteries they're producing and make as many hybrids as they can. They can likely sell them for below Tesla's prices and still receive a $7,500 tax credit. Yet they also fit with their current business model of ICE maintenance. However, these won't be ready likely until sometime in 2024 at best. By that stage, the price war may be over. I think legacy will have to cut back production. The aggregate demand for autos will compact, but Tesla are still going to maintain growth within that period, meaning that sales that reduce will only be legacy. Legacy will still have a lot of income from used cars that require servicing and parts, but the biggest risks they have is their debt. The debt is collateralized against the cars they've sold on finance. If the economy gets tough, then there'll be fewer car owners that can afford to make their payments. Legacy will have all this debt, but will lose their income to cover the payments. Whereas Tesla have over $20 billion in cash to cover them through any such event, and soon accompanied by a supporting, profitable energy business. Bottom line, whatever happens, it will be much tougher for legacy, as Tesla seems to be the least vulnerable in any economic climate. Of course, Tesla may still have other hurdles that we don't know may occur, like lithium access or something, but they're likely going to do the best they can to stay on top of that too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.